Welcome back to Alpha Recap, your aftermarket rundown from stockalpha.ai. Energetic day to recap, right? As always, if you have questions, you can reach us at stockalpha.ai and ask directly. Josh, great to have you.
Thanks for having me. Good to be here.
So, quick overview before we dig in. Markets closed with a pretty clear split. Big thematic winners and some notable losers. The headlines were dominated by AI moves, a blistering chip rally, and a few earnings shocks. Sound about right?
Yeah, absolutely. It was one of those days where macro was steady, but the sectors told very different stories.
Let's start with the big tech splash. Google said it would invest up to $40 billion in Anthropic. And then we had a V4 preview from DeepSeek. That really reignited the AI narrative. What did that mean in plain terms?
In plain terms, a huge capital signal. Google committing up to $40 billion is both a liquidity event and a strategic choice to bet on third-party model makers as well as internal development. It changes how people model demand for training GPUs, data center interconnects, and storage.
Yeah, that tracks. I mean, when you step back and look at this, it's not just the headline. It's who benefits along the chain.
Exactly. And then DeepSeek's V4 preview, that came out of China, and while the company is private, public suppliers read that as a fresh signal. When models advance, that typically raises demand assumptions for hardware and software firms that support training and deployment.
Okay, so AI momentum was back in the room, and it coincided with a semiconductor surge. The semiconductor ETF was up more than 30% month to date. That kind of move compresses future upside, doesn't it?
Right. When an ETF like that runs more than 30% in a month, traders are pricing a pretty aggressive improvement in revenue and margins. Some analysts say it's justified by structural AI demand. Others warn that it raises the bar and makes the sector more sensitive to guidance misses.
Intel had a big day in terms of volume, about 125 million shares traded, and the stock rose about 2.33% to roughly $66.78. Heavy participation indeed.
Heavy participation that can amplify moves. Higher prices plus concentrated flows mean earnings and capex signals are going to trigger bigger responses than usual.
Let's pause for 3 quick reactions. Right.
Yeah, absolutely.
Switching gears, there was also some clarity on the policy and political front. Markets had expected the Fed to hold rates at the April meeting, and the Justice Department ended its probe into the Fed chair. Josh, how did that play into the day's moves?
Analysts noted the removal of that political overhang as a stabilizer. The expectation that the Fed would hold rates kept the macro backdrop steady. That higher for longer tone stayed in place for rate-sensitive sectors. Removing the probe uncertainty simply lowered one tail risk for markets.
So macro calm, sector fireworks. That created a bifurcated market, ETFs and thematic template attracting flows, while some cyclical names and companies with mixed guidance took hits. 2 names that popped up were Graphic Packaging and Kyndryl.
Graphic Packaging missed expectations and slid, which highlights margin sensitivity in packaging and materials. Kyndryl reported about $3.9 billion in revenue for the quarter, up around 3% year over year. Modest growth, but the overall take was mixed momentum rather than acceleration.
Honestly, I was a bit surprised by how stark the split felt. Big winners on the thematic side, but real pain for guidance-sensitive names.
Yeah, the day underlined that we're not in a broad market advance. We're in concentrated flows, where a few narratives, AI, chips, space, international allocations, are dominating.
Let's unpack those themes one by one. First, AI and infrastructure. Beyond Google's cash commitment and DeepSeek, Meta also announced plans tied to Graviton chips and big AI commitments, about $48 billion in total AI outlays. What's the significance of the Graviton move?
Graviton chips are ARM-based processors that can deliver better price performance for certain workloads. Meta adopting hundreds of thousands of Graviton chips signals a multi-vendor approach, which affects cloud cost structures and the bargaining power of suppliers. It's a cost optimization and diversification play.
Right. And the other thing is, swapping in different chip architectures at scale changes capex math for hyperscalers.
Exactly.
Next up, Thematic ETF reallocation. Space and aerospace ETFs were getting flows. The relevant companies showed about $502 million in sales in the first quarter and roughly 8.8% constant currency growth. That was enough to push issuers to launch niche products. Thoughts?
Those numbers help justify thematic interest. But thematic ETFs tend to concentrate exposure in a few suppliers and prime contractors. That can amplify moves both ways, so investors need to parse index construction carefully rather than assuming broad diversification.
Good point. And there were also conversations about international equities and country ETFs as potential sources of outperformance versus the S&P.
Yes, some market commentators argued for tactical increases to international allocations, while others said U.S. tech momentum could keep domestic markets ahead in the near term. The disagreement really centers on persistence of valuation gaps and macro dynamics.
So, where did analysts diverge most sharply today?
Mainly on semiconductors, valuation versus momentum. Optimists point to structural AI demand supporting higher multiples. Skeptics worry the recent more than 30% ETF move compresses future upside and increases volatility. There was also debate about whether the Google Anthropic money and DeepSeek signals would spread value across many players or concentrate gains in a few big firms.
Hold on, say that again. Concentrated gains versus broad uplift. So some people think the big players capture most of the upside. Others think the whole stack benefits, right?
Exactly. Optimists see an accelerant across software, chips, and data centers. Skeptics see concentration risk and potential regulatory or competitive friction that could slow monetization.
Let's do a quick practical breakdown for different investor types. Traders first.
Traders and momentum players benefited from heavy volume and liquidity in names like Intel and ETFs like the Semiconductor Fund. But stretched valuations increase the risk of sharp reversals on earnings or guidance misses.
Long-term thematic investors.
The AI capital commitments and model releases bolster the long-term case for AI infrastructure in niche applications like healthcare. But adoption timelines are multi-year, and product market fit is still being proven for many use cases.
Income and value investors.
Graphic Packaging's miss was a reminder that cyclical, cash-generative sectors face margin and guidance risk. Value and income portfolios need to watch execution closely.
Fixed income folks.
With the Fed expected to hold, rates stayed elevated in the near term. That helps yield-seeking strategies via carry, but rate-sensitive sectors won't get relief yet.
And contrarian or event-driven allocators.
There were examples like a fund that outperformed in the quarter by leaning into commodity-linked trades, gains around 6.5% versus the S&P down about 4.4%. Those are high beta plays that can pay off in specific windows but remain policy sensitive.
Quick reactions. Short ones this time.
Right, got it.
Big moves. Lots of nuance.
Yep.
Before we wrap, Josh, what are the key data points folks should watch next week?
Watch semiconductor fund flows and whether breadth is broadening or narrowing. Keep an eye on Intel's volume and any near-term guidance changes. Look for specifics on the Google Anthropic arrangements and procurement signals to chip and infra vendors. Monitor DeepSeek or related model demos for capability signals. And of course, listen carefully to Fed communications and any personnel updates. Those will matter for policy expectations.
Solid checklist. Any tactical considerations? Not advice, just strategy themes to think about.
Reassess position sizing in high momentum thematic exposures. Parse index construction for ETFs. Distinguish structural from cyclical drivers. Keep a catalyst-driven watch list focused on earnings, guidance, and procurement announcements, and stress test rate-sensitive allocations in a steady rate environment.
Great. Let's close with 3 clear takeaways for listeners.
First, today was driven by concentrated thematic flows. AI, chips, and niche ETFs led the way while macro stayed steady. Second, elevated semiconductor moves mean higher sensitivity to company-level news. Momentum has compressed future upside. Third, monitor procurement signals from hyperscalers and next round earnings as the likely catalysts for near-term direction.
Perfect. And remember, this analysis is informational only. It does not constitute personalized investment advice or a recommendation to buy, sell, or hold any security. Analysts note different scenarios, and the data suggests varying outcomes.
Right. It's all about parsing the evidence and staying focused on catalysts.
Thanks, Josh, and thanks everyone for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. We'll see you next time on Alpha Recap.